Hello, everyone, and welcome. My name is Valdete Barisha, and I manage the Microfinance Gateway. Today's webinar is part of a series of 4 webinars on risk management organized by the Microfinance Gateway in partnership with the Risk Management Initiative in Microfinance. Before we begin, I would like to briefly go over a few logistical details. This is an audio broadcast, so what that means is that you'll be able to see the presentation, listen to our speakers, and use the chat box located on the right-hand side of the screen to submit your questions. Given that we expect a large number of attendees, we will unfortunately not be able to enable microphones for participants. This enables us to preserve the audio quality for everyone. So you can submit your questions at any time during the webinar using the chat box, and we will do our best to collect and ask all of them at the end of the presentations. Please make sure when you send your question that it goes to all participants. There's a drop-down menu on the chat box, so make sure that when you type in your question, the all participant option is selected, because that way we can make sure that your question is seen and addressed by the moderator. The webinar recording and related materials will all be made available on the Microfinance Gateway website within the next 2 days, and we will send you an email follow-up to let you know when they're all up. So that's all on the logistics side, and now I'm happy to turn over the mic to our moderator, Soam Park. Soam?
Thank you, Valdete and Microfinance Gateway for hosting this webinar. Good morning, everyone. Thank you all for your participants today, for joining our webinar to discuss one of the key challenges to furthering financial inclusion, or I should say responsible financial inclusion, with risk management as the engine. My name is Soam Park. I'm Principal Consultant with Magpie Venture, and we provide consulting and executive coaching services to microfinance institutions around the world. And I am honored to be the moderator for this webinar. So just to introduce our topic of the webinar, in my experience working with financial service providers in the financial inclusion space, typically when we say the word risk management, the focus tends to be on credit risk management and sometimes fraud risk management, rather than applying a comprehensive lens to managing all types and levels of risks that an institution inherently is exposed to. On top of that, this industry is constantly changing and changing rapidly. Most financial service providers grow in size. Some changes are related to their business models, such as transforming from a credit-only institution to a deposit-taking institution, perhaps, or simply offering new products and services to different market segments that have varying risk characteristics, and reaching through different delivery channels, such as extending digital financial services. Or what about the environment? The very nature of financial inclusion industry, we operate in one of the most vulnerable environments, politically, economically, sometimes in war zones, and also reaching vulnerable population. We haven't even gone into the changes in funding, in their pricing, or currency in the funding and structures as well. So with all these uncertainties and changes comes risks, and new levels of risk exposure to manage. How should financial service providers manage these risks and keep up with the changes? In other words, how do you integrate risk management into decision-making and core business processes? How should the rest of the industry, such as funders, consultants like myself, or technical assistance facilities, regulators in country, provide a targeted support? We ultimately serve a double bottom line, and How do we ensure that risk management fits into the financial and social mission? And where do we find resources that are appropriate for double bottom line? So to discuss these issues, we have with us, if we can move to the next slide. I'm sorry, I'm unable to move the slide. Thank you so much. To discuss these issues, we have with us today our three speakers who have a great deal of experience and knowledge in financial inclusion and risk management, and are able to provide various perspectives on this topic. Our first speaker on the left is Aldo Moro, the Executive Director of Microfinance Rating. His wealth of first-hand experience with financial service providers is really invaluable. He has personally carried out more than 200 ratings in more than 60 countries, chaired more than 300 rating committees. Microfinance is a European-based rating agency with global outreach and qualified by a variety of national and international authorities such as European Investment Bank, Smart Campaign, and others. And their rating methodology includes the assessment of the risk management framework as well. Our next speaker is Kevin Fryatt, who is the Director of RIM, Risk Management Initiative. He's been really at the forefront of bringing this subject of risk management into the financial inclusion space. He's the risk management subject matter expert for also Accion's Africa Board Fellowship Program. Previously, he served as Director of Advisory Services with MXX Solutions, leading their education and capacity building in Sub-Saharan Africa. He's also served as Microfinance Technical Advisor for World Relief, overseeing the global network of microfinance institutions. In addition to serving in SEEP's Financial Services Working Group in developing reporting standards, as well as serving on numerous MFI, microfinance institutions boards, in addition to having worked in over 20 countries. Our third speaker is Daniela Renat, who is the Risk Management Advisor at Access Microfinance Holding. She is leading their project to develop a group risk management framework, which I believe she'll go into more during her presentation. Access Holding operates a network of commercial banks and microfinance institutions in developing and transition countries with a target group focus on micro, small, and medium-sized enterprises. The Access Group currently comprises 10 microfinance institutions with the aggregated asset of over 1 billion euros. So Aldo will kick us off with his thoughts on the industry-wide challenges and gaps for furthering financial inclusion and risk management, some of the core characteristics observed from the perspective of a rating agency, and of course, when there's challenges, entrepreneurs and innovative thinkers see opportunities. Kevin will introduce RIM, Risk Management Initiative, how RIM has responded to this opportunity to address the challenges the industry has seen, what solutions RIM offers. And Daniela will then share with us how Access Holding has adapted some of RIM solutions and the experience of applying to its partner banks on the ground. Just again, a quick reminder to encourage you to send your questions in the chat box, as Valdete said already, throughout the presentation, and we hope for a dynamic discussion today. Without further ado, I'd like to hand over to Aldo.
Thank you. We, as a rating agency at global level, have a privileged observation point on the industry evolution by rating microfinance institutions of all types and in very different environments. And as it has been said, the risk management assessment represents an important pillar of our rating methodology. I can indeed provide an updated, let's say, situation or perception of the situation that we have at this level, by saying that indeed there is a basic failure by institutions to understand the importance of managing risk. There is a difficulty also sometimes in accessing to the necessary expertise, and of course more recently the emergence of some new and unfamiliar risks which are resulting from innovation and change. Risk management from a good part of the institutions is often seen as a sort of extra cost, in the sense of organizing a proper department, a proper function within the institution, and with no clearly identified value added. Many institutions, they do not yet have a comprehensive risk management framework. They do not have an internal risk department. They still depend a lot from external auditors, which most of the time do not get to the bottom of the issues that are exposing exposing the institution to risk. We notice a basic problem and weakness when we look at the risk management cycle. Of course, risk management is a dynamic and continuous process of identification and management of risks. And in particular, the last two parts of the process, which refer to monitoring risks and revision of policies and procedures according to the evolution and the growth of the institution, these aspects are not well organized and well implemented by many institutions that we rate, and represent a clear weakness within the whole process. Let's say that overall, I believe that the basics of risk management are in place in institutions. For the traditional risks, well, the great risk, as it has been mentioned earlier, but not necessarily for the growing complexities created by market level risks. And I refer, of course, to competition and growth. Of course, there is a rapid growth of digital finance, and this is creating a whole new category of risks that I would say are largely unknown. From our perspective as a specialized rating agency in microfinance, we look at the institution with let's say our experts have a 360-degree view, let's say. Basically, we are expert on both risk management and client protection and social performance management. So, as opposed to an 180 degrees view, which only looks at the risk management. When we implement a rating exercise, we are assessing and giving our opinions for the improvements of both the risk management framework and at the same time the client protection part, which have to go together, which have indeed to work together, as they are part of the same structure, the same house, as the microfinance, a double bottom line kind of business. And indeed, the growth of these institutions represent the main challenge that that put this institution in front of the need to consider both aspects. And again, the monitoring, I mean, the evolution and the growth of the institution is creates the need to revise, to monitor and revise in a better way the risk management framework and adapt it to the new situation, the new dimension. So the possibility to work to have an approach which looks at both sides, so the risk management improvement and together and aligned with improvement in client protection and social performance, could also motivate the institutions, avoiding a so-called TA fatigue that we have also observed in many cases where the institutions are inundated of TA services and they don't really understand the value added of it, and this is creating some TA fatigue. And the possibility to work in with such a comprehensive approach would mitigate this aspect. I think that we have in front of us challenges, and the RIM, the Risk Management Initiative, has spent the past 4 years addressing issues faced in risk management, including the rollout of the graduation model framework. And Kevin Friett, the next speaker, will now share with us how the graduation model addresses some of the core challenges we face, as well as provide insight into other resources RIM makes available to the industry. So Kevin Friett, the floor is yours.
Great, thanks Aldo, and good morning, good afternoon to those of you who are in the U.S. and overseas. And as Aldo, I think, rightly mentioned, there are a number of challenges that we've been working on over the last number of years. And I think that one of the questions that Saun raised in the very beginning is something that I want to kind of bring us back to. And given our quest, let's say, for responsible financial inclusion, and I think that word responsible is something that maybe gets thrown around fairly lightly. But in our quest for responsible financial inclusion, how do we ensure that as we're driving our businesses forward, that we actually are acting responsibly from the point of view of risk management? And how do we ensure that our risk management systems and approaches are growing with the complexity of our business and growing over the course of time? And I think one of the other things that I would point out is, I think Aldo mentioned it as well, but I think it's worth bringing up again, is institutions who've grown up quite quickly, and I think we've seen that in the sector across the board, but whose risk management function hasn't necessarily grown. And I think, like Aldo rightly mentioned, sometimes it's seen as an extra cost, and the value of it is maybe difficult to quantify. So for us, I think what we're looking at, what we've been doing over the last 4 years, is really creating a path towards more appropriate risk management, and I can discuss a bit about that word appropriate. Since 2013, we've spent a lot of time, energy, and effort on developing the graduation model. And what the graduation model is a framework for institutions within financial inclusion to easily improve and then strategically develop their internal risk management systems. And going back to that point of appropriateness, how does the graduation model maybe solve the question of appropriateness? I think the first point is really that the graduation model essentially matches the business that we're in. So we're in financial inclusion. We inherently have a double bottom line. And I think a lot of traditional risk management frameworks where they've either been developed or borrowed from, let's say, another industry, haven't necessarily viewed risk from a double bottom line perspective. Risk is defined inherently as the risk of financial losses, but how can we view risk from a single bottom line perspective when in fact the very decisions that we make should be made in the view of both of our bottom lines, and we should be feeling that tension. So the graduation model ultimately provides guidelines in the form of the types of policies, the types of limits, and the types of tools, both risk management tools as well as risk monitoring tools, that institutions should adhere to as they grow and develop. And what this ends up doing, given that the framework is a scalable framework, so it's based on certain tier levels. So as you can see on the slides, it's from tier 3 to tier 1. Tier 3 being the least complex, tier 1 being the most complex, and as your institution grows, you can then adopt new and more complex risk management systems as you go. And what the graduation model does is provide you visibility ahead of time on what you actually need. Similarly, it's comprehensive in nature, and I think both Saun and Aldo mentioned this point of moving beyond let's say credit risk management, for example. Even though that's sort of the core of our assets on the balance sheet, there's a lot of different risks coming into the sector and have been in the sector for a while, but oftentimes are not given the attention that they need, and maybe institutions are exposed and maybe left out to dry, if you were, in terms of how to manage and set the systems and structures internally to manage these risks. This graduation model is available on our website, so it's something that the general public can go and explore. You can do this by going to our website, riminitiative.org, and navigating through the graduation model menu, which you can see. And you can see really the cascading complexity both of the sort of the tier levels as we move from left to right, tier 3 to tier 1, as well as the risk management structures that should be in place. And for this example, we've chosen financial risk for a deposit-taking institution, and under currency risk or FX risk, risk monitoring tools. And in a tier 1 institution, there's quite a array of different types of tools that can be employed by an institution, and we would say should be employed if you're a tier 1 institution. In terms of implementing the model, I think as Saun mentioned, Daniela is going to be sharing some of her experience in rolling out the graduation model within Access Holdings affiliate banks and institutions. From RIM's perspective, the institution assessment is really the hallmark way of implementing the graduation model. What an institution assessment is really a strategic process for financial institutions, and designed to, number one, reveal gaps in risk management systems, but I think more importantly is to take those findings and then strategically and proactively bring these into alignment and develop a plan to do so where the institution's risk management systems and business strategy are aligned. RIM provides training both to folks within institutions, so risk managers, CFOs, internal auditors, et cetera, and depending on what type of institution you have and how large it might be, the risk management function may be housed within any one of those individuals. But we provide training to internal staff as well as to independent assessors who, once they're trained, are part of our assessor database, which is one of these solutions near the bottom, which is a directory available to the industry of trained individuals who are available to the industry for hire to implement these institution assessments across the world. The assessment takes place and the training takes place within our assessment toolkits, and these will be the focus of this assessment process, both for independent assessors and internal staff, will be the focus of webinars 2 and 3 in our webinar series. So I'd encourage those of you who are consultants or risk management experts, consulting firms, definitely want to attend webinar 2. And then for those of you who are staff within institutions and want to learn more about more of a self-assessment process, definitely come to webinar 3. Working groups is something that we also have available for our members, and these working groups are member-led groups which essentially form to discuss and work on key issues within and related to risk management. So we currently have a group, the Network Risk Reporting Group, which is focused on risk data aggregation at a network level, and then we also have a group forming on fraud risk in the changing landscape of financial inclusion and really focusing in on digital financial services and the like. One of the tools in our toolkits is the knowledge base, and this is something that is a member resource available to RIM members. We're providing a 30-day trial to folks who are on the webinar. So I think there's going to be a survey that you can respond to here, which you can, if you want access to this knowledge base, feel free to click yes on the survey question, and we'll send information after the webinar as to where you can actually get access to this. There's on the bottom left of the slide here, you'll see kind of a little box. This is actually, if you go onto our website, riminitiative.org, we'll give you a code at the end of the webinar that you can actually sign up for this as well. So look out for that. Essentially what the knowledge base is it's an exhaustive resource for understanding each criteria in the graduation model, and it's really used and designed to be used within the institution assessment process, while also providing an easy-to-use reference guide for different different aspects of risk management. So this is something that at the end of the webinar we'll also give instructions on how to sign up for that. In terms of the graduation model, where it's been implemented and deployed, here's a few examples, some of which are kind of the foundations of a training program in Luxembourg. Others are through an institution assessment process in Zimbabwe, as well as many others around the world. One of them is AB Bank in Zambia, and I want to pass the presentation off to Daniela because she's part of Access Holding, AB Bank being one of their affiliates in Zambia, and they've gone through a process and are currently going through a process of adopting the graduation model in their network. So Daniela, maybe I'll pass it to you and feel free to share your experience.
Yes, so thank you, Kevin, and hello to all participants. Let me go to the next slide, of course. So I will start with some backward information. So Access Holding operates a network of 10 commercial banks and MFIs in developing and transition countries, so spread over Africa, Latin America, and Central Asia. So what is pretty important here is that the portfolio is very diverse in terms of age. So we have banks that are 3 years old to banks that are 19 years old, and also in size and structure. So some are deposit taking, some are non-deposit taking, and as well as the regulatory background of the countries. So some are non-regulated, while other countries even adopted Basel III. And during the last years, it could be observed that the need for adequate risk management has grown significantly. Requested from different parties, so regulators, lenders, and most important also from the business itself, which became more and more complex. Thus, the need to develop an adequate risk management framework has grown, so an appropriate benchmark for microfinance institutions was actually needed. And this is how WIM and the graduation model came into play here. So talking about our experiences with WIM and the graduation model, it actually happened here on 2 levels. So one is the single entities. So some banks started to develop a risk management framework, and as a starting point, we provided them with a graduation model self-assessment tool that you just mentioned, Kevin, and they conducted that by themselves. So Access Bank Zambia has even been a graduation model pilot bank, as we already have heard. And our banks also in Madagascar and Nigeria have started to implement a risk management framework or to develop a risk management framework based on the graduation model. What you can also see here for these banks is a tier classification that WIM bases on, that the graduation model bases on. So it points out again how diverse our network actually is. So here we have presented tier 2 and tier 3, but we also have institutes in the network with tier 1. And on the other side, we are also working with WIM and the model on group level. So while developing a group risk management framework and set standards for the whole group, we also look now at the graduation model. But here we are only in the starting process, so I cannot share any details on that, unfortunately, only on the bank's level. So how does the graduation model and WIM provide benefit and value to us? So primarily, it provides a best practice standard and guidelines for risk management in our banks, or also MFIs, based on their level of maturity, so means on their tier level. And this is actually what we needed for, as we are that diverse. It comes along with the self-assessment tool for gap analysis that Kevin just presented. And as we find, it's easily applicable by the banks itself. And thus, it was definitely reducing our efforts from our side, as we could just distribute it to the banks and they could do this initial self-assessment on their own. Additionally, WIN maintains this online knowledge base that you have just seen actually presented by Kevin. It really provides valuable input on risk management practices, and you can always look it up online. So if we have questions about policies, tools, limits, so it tells you what it's about and also what is important about it. And what also is very interesting for us, besides the tools, is actually the participation in these working groups. And you get the chance actually to contribute to the further development of the model. So the current working group, where I'm also participating, is the one for network risk reporting. Okay, let's have a look at one example how it looks in practice. So one of our banks started a project to implement a proper risk management framework, applying the graduation model. So in the first step, it identified the tier level. So it used the tool provided by WIM, as you can see here on the screen, and according to the selections for different parameters for sustainability, size, transparency, the output here was tier 2 for our bank. So in the second step, based on the results of the tier level classification, the bank performed a gap analysis with a self-assessment tool provided by WIM. The output is this nice spiders web chart you can see here on the screen. So it shows you for each risk area, so foundation, strategic risk management, credit risk, financial risk management, operational risk, and also financial and social goals, and how far your risk management practice in the bank covers the graduation model guidelines. And as you can see here, the biggest gaps could be identified for strategic risk management, financial risk management, and also operational risk management, while credit risk management was actually properly somehow better covered than the other risks. And this is also the point that Aldo already pointed out. So the bank then used these results of this gap analysis to set up a project plan in order to fill these gaps and to build an appropriate risk management framework. So from the banks itself, the feedback is very similar to what we experienced. So they said that the graduation model provides a very helpful starting point to develop a risk management framework. Because the tool is just very helpful to identify your gaps between the model and the bank's actual risk management practices. And they provide guidelines on what kind of policy, tools, limits the bank should have in place. And a benchmark like this was, from our point of view, always missing for microfinance institutions. And one really interesting point is also what they experienced is even proved to be beneficial in discussions with external parties, so in the due diligence process, when they mentioned that they develop a risk management framework and base it on this graduation model. So yes, thank you very much. So I will now give the word back to Saun for the Q&A session.
Thank you very much, Daniela, Aldo, and Kevin for sharing your insights and your presentation. I think the key takeaway for me is that risk management really isn't we're not talking about anything new. It's something we've already been doing, as Aldo and has already mentioned, and Daniela also just pointed out. And it's just really bringing us back to the very basics of providing responsible financial services to the underbanked population, and comprehensive risk management framework and a standardized approach, or should we say like guidelines provided in a standardized approach, seems foundational to our mission regardless of various maturity level of institutions that we're talking about here today. So the next 25 minutes or so are for you, our listeners here online today. We've already been receiving a couple of great questions, and want to just encourage those of you who haven't already keyed in your questions yet to do so under the chat box. Make sure that you choose for it to go to all participants, and we'll try our best to cover as many questions as we can today, although we may not be able to get to all of them. And I'd just like to kick us off with the very first question that may be on all of our minds right now. It's for you, Kevin. We've heard about the various RIM resources that are available for public, and also you mentioned about what's available for webinar participants. Where can we find them?
Great question. So yeah, the different resources are available on our website, some of which are available to the public, like I mentioned. Others are available to RIM members. And there's information on our website in terms of how do you become a RIM member. I think the one thing that I will mention, because we did mention the knowledge base, is and trial access to that. If you go onto our website and on the home page, as I mentioned earlier, you'll see this 30-day trial sort of button. If you're to press that, it's going to ask you to sign up for a trial membership, and the last field in that form is a sign-up code. And what you need to do is type in RIM-free30 when you sign up, and you will get access to the knowledge base. And just to remind people, where you access the knowledge base essentially is on our website under the graduation model menu. And then once you click on the graduation model menu or have the different risk areas drop down, you can click into any one of those risk areas, and then you'll essentially see the graduation model there. You can then drill down into each of the guidelines like Daniela was mentioning, and see more of the information, which essentially is our knowledge base. So feel free to sign up for that. The other thing that's available also that I'll make mention of is our working groups, and we have a brainstorming call coming up on the 26th of April. And this is really designed for both our membership as well as kind of the industry at large to discuss some of the key issues and discuss different types of working groups that can form to address some of these key issues. So that's something that you can also sign up for, and I've provided the link on here, which is essentially under the events menu of our website, and it's the working group brainstorming session. You can sign up on our website through that. The other resources in terms of the toolkits that we'll discuss in webinar 2 and 3, we'll discuss those more in those webinars, but these are resources that are available to members only. And also, what I would mention is that for folks who go through our trainings to get trained within the assessment process, you're granted a complimentary one-year membership as well, which gives you access to all of those resources as well. So I think that covers everything.
Great, thank you, Kevin. So we'll take the first question from our audience. I think this question is about wanting to hear a little bit more of the experience on the ground and what would be the percentage, if you will, or level of risk management that already exists with the microfinance institutions. And I think this question might be perhaps appropriate for Aldo. I'm going to ask you, what have you seen on the ground as you've been doing many ratings with the MFIs over the years? You mentioned some basic risk management is already being done. And also, if you could add to that, what are some of the main aspects of a risk management framework is conducted as a rating of a microfinance institution?
Yes, I mentioned already some points and some weaknesses we normally observe. I would say that the basics of risk management are there in microfinance institutions, but this doesn't mean that the risk framework is appropriate and comprehensive and solid enough, especially when there is a strong growth and an evolution in terms of the market and the services that the institution wants to provide. So the most important aspect we notice is the lack of a proper function dedicated to risk management. Of course, we're talking about institutions that can, that have to organize such a function and have already reached a dimension and let's say dimension and the level of sophistication that justifies a proper department or a proper investment in a person or more persons dedicated to that. Overall, even if institutions are not big enough, they have policies and procedures and also a governance structure which is not yet adequate to deal with the risk management process, again, as a process, as a systematic process, and the monitoring and revision part of this process is really quite weak in terms of policies. The situation right now, as I said, is very, very challenging, but interesting at the same time, as there is an evolution of a very quick and fast evolution. If we consider the dynamicity of the market and the growing complexities generated by the big competition in many countries and the very fast growth, as well as the growth of digital finance, which again is really creating new category of risks. And I think the RIM graduation model, which we also participated to the creation and definition at the beginning, is very clearly and well considering this aspect. You know, the creation of a common language as well, common definition of risks and categories to which we refer, and the best practices to deal with the management of those risk risk categories.
Great. So I think I'm going to add a follow-up question that also came from our audience today, which is really regarding around, as you say, Aldo, evolution and mention of the digital finance that's been mentioned several times now. And so it's really at the level of business model, and I think digital finance is in a lot of people's minds. Kevin, could you talk just a bit about what you see and how you see the graduation model and the RIMS resources that's been developed in terms of best practices and guidelines that's been really developed for all types of microfinance institutions and different business models, how this could be applied to the MFIs that are going digital. And I'd also like to add, along with that, even for those who are targeting a different kind of population, or let's say, for instance, in Islamic countries, there are some Islamic products that may be offered. How would this model apply to these different types of business models?
Sure. Thanks, Simon. No, I think it's great questions. So in terms of MFIs, let's say, going digital, I think one of the challenges that I've seen in that move is let's say maybe jumping into digital financial services without a proper analysis, let's say, of either current risk management systems or the way that institutions move into new delivery channels. What the graduation model was designed for is, like as Aldo mentioned, sort of a benchmark for a financial institution, let's say a brick and mortar financial institution. And I think what we're exploring now, and I think this is referencing to some of our working group activities moving forward in terms of that changing landscape, is exploring how can we actually build out this framework for very specific sort of segments of the industry, whether it be digital financial services, agent banking, whether it be Islamic finance or what have you. And I think there's even a project ongoing right now taking the graduation model and applying it to a microfinance investment vehicle and seeing how much overlap there is between this framework and what the business model of a microfinance investment vehicle. So I think what we've found is that this framework is a nice sort of let's say starting point, and there's been a lot of interesting uses of it beyond just at an institutional level, and I think exploring some of those in the future, whether it has to do with digital financial services. Another example is in Costa Rica, where we had the Development Banking Authority do a project internally that looked at using the graduation model actually as a monitoring tool to monitor their investments. So I think we're seeing a lot of different types of uses for the framework, and the framework is sort of the baseline, I guess, for doing a lot of different things. And I think exploring some of these issues related to Islamic finance or digital financial services is something that we would look to build out within working groups, similar to how we did early on within the development of the graduation model itself. So just to provide some light on that development process lasted roughly, give or take, about 18 months with piloting and testing and all of that, but it was done through a working group process, very collaborative, very collaborative in nature, and really trying to bring the best practices to light from a variety of different people in the industry and folks within that working group setting. So, but yeah, I think there's to answer that question, it's really kind of using the graduation model as sort of board to look at different, whether it be ways of layering on top of kind of the existing graduation model, having another element of the model that deals with certain elements of business models as they progress, or if it's something else, I think that's open for exploration.
For any level of maturity of a financial institution as well, whether it be an NGO-based model to a deposit-taking, a bank in any of the regions.
Sorry, I missed the first part of your question, Sam.
I think what I'm hearing from you, Kevin, is that this graduation model, it is applicable to different maturity levels of the institution, as well as other business models that you just talked about. So it could be applicable to an NGO that's credit only institution to all the way to deposit taking. Is that correct?
Yeah, I think that was inherent in the design, and as we designed this, we really asked ourselves the question and had to make critical decisions in terms of what made it into the framework and what didn't. And what we wanted to do was, I think, firstly, we knew in developing this that we were not going to make everybody happy. And I think what we aim to do is make as many people happy as possible. So on the low end of the tier scale, so tier 3s, we wanted to create a framework that got as many people who felt left out of the risk management discussion onto the framework as soon as possible, and not necessarily creating sophisticated barriers to getting on to a framework that you can grow with. And then at the top end, the model was tested against certain regulatory requirements in certain countries and found to live up to those quite well. Some of the feedback that we've received, let's say from a bank in the Philippines, basically saying, well, the regulators tell us that we need A, B, and C, but the graduation model actually helps me fill in the blanks of what those actually are. So if I need an asset liability management policy, what is it that should actually be in that? Like what are these things that, or if I need a credit policy, what makes up a comprehensive credit policy? So I think what we find, or what we're seeing, is that this is really filling a gap even for regulated institutions who may not have a full scope of understanding of what regulators are asking for. So yeah, and I think to answer your question, it is NGOs all the way up to microfinance banks, like I think examples that Danielle has given with their institutions, as well as some of the work that RIM's been involved with its members over the last few years. So yeah, it is trying to capture as much of the industry as possible. And I think even just maybe my last point is, within the development and testing of this, we did test it with credit unions, NGOs, microfinance banks, and trying to get a large enough kind of picture of the industry as possible, and reflect that within the framework.
Great. And so, I mean, you mentioned regulators, and I think one of the questions that we may be asking as we hear about this graduation model is that, how is it different from the guidelines that are put forward by financial regulators? And also, I mean, this question is really open to all panelists. How is this different from institutional rating that also assesses in regards to risk management framework?
Sure. And maybe I'll just jump in quick here and then let others chime in as well.
Sure.
I think what we typically tell people is if your regulators are telling you to be doing something, you need to be doing what your regulators are saying. Let the graduation model add value to what the regulators are asking you for. I think the question of how does it differ is going to be, the answer is going to be different depending on whichever country you're in and what the regulators are asking you for. But I think the key difference between this and a rating process is this is really a strategic planning tool and process. I would say more so a process than a tool. The tool helps the process, but the assessment process is really a strategic planning tool where I think we do well building out our business plan for 5 years, but I have very rarely seen an institution actually strategically plan its risk management function to line up with its business strategy. And that's essentially what the institution assessment process and what we train both consultants as well as staff within institutions in is, how do you do that gap analysis to understand where you're at, but then also how do you facilitate this strategic planning discussion or this strategic discussion to say, how do we build out some of these functions? Because resources are limited, and we have to make critical decisions. So that's a critical conversation that we have to have in terms of how do we spend the resources, the limited resources we have, and where's our business going? What are the risks involved, and how do we set some of those structures up to help manage some of this?
Yes, I fully agree with Kevin. We are also regulated as a rating agency in some few countries, unfortunately still few, still 3 or 4, where the rating is considered as part of the supervision activity by the regulator. So we know quite well, of course, the regulation and the prudential requirements by those regulators, and I would say we also know the other countries' regulations. And in general, you have, of course, good regulations and bad regulations, more adequate regulations for microfinance or just banking regulations. But when it comes to risk management, you normally have, yes, minimum requirements in terms of maybe governance structure or bodies that have to be created, or types of curriculum and profile of the members. You rarely have instructions or requirements which goes towards the direction that Kevin was signaling. So to have proper risk management policies aligned with the business strategy, aligned with the social mission, and the institution. I mean, at the end, they could have the structure, but the contents are not well developed, the procedures are not there, and the function is not clearly set up.
Mm-hmm. Great, thank you, Aldo. I'm getting a lot of questions from the audience regarding the availability of slides and the webinar recording, as well as where to find some of these tools, and questions around membership. And I think Valdete will be going over that at the end as well. And as we're getting close to the top of the hour, I'd like to just ask one final question to Daniela. Access Holding and the banks and the MFI partners that you have been working with also serve a double bottom line, if you will. And so just wanted to ask you how some of these RIM guidelines and the graduation model has been able to support that double bottom line mission of the institutions from your perspective.
Yeah, as RIM also concentrates and puts its full focus on social growth, and this is also well presented in that framework, and also in the assessment tool. So our banks lacked actually in the social part somehow, and as you could also see on the slide. So we are busy working on that. So in that part, it's covered in the framework and could also support our banks in there.
Okay, great. So it's in the, I guess, the framework that's been provided and the tools that's been applied to the model.
Yeah, exactly. That's
okay. Okay, excellent. Anybody else to add in terms of the question around achieving both? You know, it's a really important point regarding, you know, when we talk about risks, we really tend to focus more on the financial risks and the financial loss should we not manage certain risks. And we are in a financial inclusion industry where we have a clear social mission. How do we ensure that risk management really serves as an engine to responsible or meeting those double bottom line mission? Kevin or Aldo, any last words?
Yeah, just maybe I'll jump in here. It's Kevin here. Yeah, I just go back to kind of how we've designed this framework, and I think in those discussions and in the development process, we really felt it necessary to go back to the fundamental definition of what risk is. So, like you mentioned, so we give a lot of attention to, let's say, quantifying risk by looking at the potential financial loss, but making decisions as a business, we have to essentially make these decisions looking at both sides of our bottom line. So is our social bottom line and our financial bottom line, and that's the fundamental reason why we've defined risk differently, and defined it in both ways, both the potential impact to our financial bottom line as well as our social mission as well. So, and I think that's really the only way that we can do this, to have the impact, to be responsible, to make responsible decisions as a business. We have to include that as part of the conversation. And it's, I think, given the track record of looking at risk from a financial bottom line, it's not too surprising to me that reputation risk and some of the issues facing the sector now are issues, because if that piece of it isn't in a part of your decision-making framework, that's inevitable to come up. So I think in terms of wrapping back to the original title of this whole thing, the risk management, the engine for responsible financial inclusion, I think that's at the crux of it. That's what it's all about, is having a framework where when we're making decisions, we feel that tension between our financial and our social bottom lines. Otherwise, it might be something like that we like to talk about, but in practice, it really lacks.
And just to give you some very concrete and practical examples of all this, a good policy of assessment of the repayment capacity of a client is good for credit risk management, but also to prevention of over-indebtedness of clients. A serious internal audit reduces the fraud risk, but also the risk of abusive behaviors towards clients. A hedging policy is mitigating market risk, but also the over-indebtedness risk, because it avoids loans in hard currency for the client, exposing him to this risk. So it's just some few examples of what we're talking about when mapping risks, considering both let's say the business approach, the typical business approach and risk management approach, with the social performance and client protection approach.
Excellent. Thank you, Aldo. That's, yes, really well said. And I think we're really getting into the crux of our discussion today. And unfortunately, we have to end because we've actually even gone over our time. But I'll now pass back to Valdete to conclude our webinar and also tell us a bit about where we can find these resources and the tools that we've talked about today.
Thank you, Saun, and thanks to the speakers for their presentation. As I said earlier during the webinar, we will make the webinar recording and all the related materials available on the Microfinance Gateway website within the next 2 days. So be in the lookout for an email from Microfinance Gateway that will provide you the link to the site where you can go and access all of these resources. In the meantime, before I sign off, I wanted to ask everyone to take a really brief survey, which will help us to understand, to get your feedback, and to understand a little bit what your needs are in terms of future webinars, as well as just what you thought about the overall relevance and quality of this webinar. We also have a LinkedIn group, and I'm going to post the LinkedIn group link on the chat box. You can click on the LinkedIn group and join the group and continue the discussion there. If there were any questions that were remaining and weren't able to be answered during the webinar, please feel free to join the group and connect with the speakers and connect with other peers and continue the discussion there. We also have upcoming webinars, 3 upcoming webinars in the series, and the registration is open for all of them. The next one is on April 5th, and it will provide more details for consultants who are supporting the microfinance institutions and other financial service providers to establish a risk management strategy. So I'm going to post all of these links in the chat box, and feel free to click on them and register, join the group, and you can also go on RIM's website to subscribe to receive the toolkits that were presented during the webinar. So once again, thank you for joining us, and we hope to see you in our upcoming webinar on April 5th. Thanks to everyone.